as a California native growing up in LA, attending college up at UC Santa Barbara, and eventually making my way down to San Diego, um, I'm aware of the unique challenges inherent to the state of California uh, for natural disasters, like wildfire. However, there's a bit of a myth that needs to be debunked, which is uh, natural disasters it's a global problem. And it's an issue that affects uh, much of the world. And we can recognize that just for the United States. In the Eastern Seaboard, you have hurricanes. So it's not only for Florida, it's for the Carolinas, uh, it's for Mississippi, a number of the Eastern Seaboard states. You've got flooding issues, flooding in the Midwest, and of course, the large flood we all experienced with Houston in 2017. You've got hail and snow, which is we don't have it prevalent here, but in Colorado, Texas, Oklahoma, that's a big issue. And understanding these natural disasters will help you also begin to understand the financial burden that this is causing for insurance companies. In across the board, the the financial strain, the cost to cover claims has in the state of California been stifled by legislation. And this has been pushing carriers to it's a bit of a mass exodus or a moratorium that we're all experiencing here in the state of California. A number of carriers that you would know by their name, have left California. AIG has left. Kemper has left. State Farm, they announced in May of 2023, they're putting a moratorium on writing new insurance policies and beginning a process to non-renew a number of homeowners. I think the number was something like 73,000. Allstate also put a moratorium, not writing any new homeowners insurance policies. Farmers followed suit as well. Again, just the list goes on. Chubb Insurance for some of the high value real estate, Chubb, Pure, and Cincinnati, all have certain criteria that need to be met. You have to have a home that has at least a $3 million replacement cost value. So that's not market cost, that's replacement cost. It's been a challenge for California. So take a quick. So the question is, why are they leaving? The first part that I want to talk about is natural disasters. So it's really the frequency and the intensity of these natural disasters. And I'm just going to read off here some numbers. I'm assuming it's a numbers-friendly crowd here. But if you look at billion-dollar disasters as a whole for the United States, in the 1990s, there was $53 billion of natural disasters. In the 2000s, that went to 59. So about a 10% increase, not that big. But in the 2010s, the number surged to 119. That's almost 100% increase. Now in the 2020s, here we are, 23, 24, and it's already at 90 billion. So you can start to see how that's just escalates. Wildfires, 2000s, it was 6.9, 2010, 7.1. But in the 2020s already, it's at 10 million. Hurricanes experiencing a similar increase. Won't go all through the numbers, but hurricanes and floods just continue to the intensity, the severity, and the frequency have all jumped. And what this does is this, of course, increases claims and increases the financial strain that is put upon the carriers. When you have this massive increase of disasters like this, the payouts become have outstripped their ability to cover premiums enough to make it a viable business. And a second piece that I want to introduce is what's called the catastrophic risk concept. So in California, what this refers to is it's the heightened risk of the severity and the large-scale disasters. So again, if you're looking at California, it's wildfires, it's earthquakes, and it's floods. The frequency and severity, we've already gone over how the frequency has taken a quantum leap. And then the severities, some of you may remember a disaster that happened up in Montecito, up by Santa Barbara, up by my alma mater. There was a perfect storm, as you will, in that there was wildfire that ripped through Montecito. There's concentration of high-value real estate in that area that was covered by a lot of shrubbery and brush. Well, a wildfire came through and decimated all the underbrush. And then in the middle of the night, they experienced an incredible rainstorm. I can't tell you how many inches poured per hour, but what happened is with all the undergrowth burned out and the heavy downpour that came down, it created a massive mudslide. It claimed the lives of a lot of the residents. It wiped out Highway 101. There were car-sized boulders that made it all the way to the beach from the top of the Montecito and the Santa Barbara Riviera area. It was terrible. And again, just the concentration of assets. California has a large population, high property values, and especially in urban areas. So when you have a disaster, a catastrophic disaster, the expense is extraordinary. And then the last part is the regulatory environment. So what's happening is back in 1988, there was what was Proposition 103. Some of you in this room may know what that is, but Proposition 103 was a bill that was passed that limited from a percentage basis how much insurance carriers could increase their rates year over year. So as you can imagine, this was a very popular bill that was passed quite quickly and was able to exist for a number of decades before that legislation just became outdated. The existing California insurance, the insurance commissioner has been under an incredible pressure the last 18 to 24 months to change this legislature. Because what's happening is carriers are just not able to take in the premium that's needed to match the level of losses that are coming through. So what you're seeing, and we'll get into that in just a few minutes, is how the regulatory environment is going to have to change in order for this to sustain the California insurance market. We'll go on to the next slide. So what are the options for property owners? And this could be for commercial property owners rental property, also for personal homes. So in oh, I thought I heard something there. I just moved my microphone. So the carriers that are still writing new policies, I'll give you an example. Our agency is an agency that's been in San Diego for over 40 years. We have all the necessary appointments with the top insurance carriers. The Travelers, Safeco, which is Liberty Mutual, Nationwide, and Mercury were all great middle tier carriers that provided competitive rates and rapid availability, and there was a lot of competition. Today, Travelers moratorium, Nationwide moratorium, Safeco, Liberty Mutual also moratorium. So the only carrier that's handling this midsection for us is Mercury. And Mercury used to have 24 to 48 hour quote turnarounds. That time, turnaround time is now 2 to 3 weeks. The carrier is overwhelmed, and there's just not much competition. We're telling clients just to stay put with what they have. In years past, we used to have 3 to 5 carriers that would be tripping over themselves to provide competitive rates. That's just no longer the case. We tell people just hold on to what you have, even though they're going through significant increases in premium. The California Fair Plan, you may be familiar with what this is. The California Fair Plan is while it's a state-run program, the insurance carriers that are insuring these policies are all the same carriers that you hear about and know. So State Farm, Allstate, Farmers, Travelers, Liberty Mutual, etc. However, it is a property-only policy, and it only covers fire. So the reason the California Fair Plan was put in place was lenders that have notes, loans on properties are only concerned about the actual structure. They're not concerned so much on the liability side. And so for a lot of folks that have low interest loans out there, they have to protect at least the value of the note on the particular property. So a California Fair Plan, again, a strip down, there's no liability, there's no theft coverage, there's no water damage coverage. It is property only, and the only peril it covers is fire. So again, it's if you have to go to the California Fair Plan, it's your last, I wouldn't say it's the carrier of last option, but it's the last option. And the state put it together so as to protect the loan instruments for people owning property. Excess and surplus lines. What these carriers are they're carriers that don't have to abide by the rate increases set by California insurance commissioner. They are regulated, yet Lloyd's of London is probably a great example of what a surplus carrier is. They come in, they're going to make their own rates. They still have to comply to California statutes. And excess and surplus lines carriers are great options. You want to make sure that the carrier has at least an A rating from a financial stability. That's the biggest thing to look out. And anytime you're looking at a surplus lines policy, be expecting at least a 2x increase in price, sometimes as much as 3 and 4x. Again, it's a classic supply and demand issue there.
Quick question, Bill, since you mentioned Lloyd's, I know after we had the fires up there by the Getty, we had some clients that were up there and they said Lloyd's wouldn't underwrite them anymore either. Are they still doing the policies for the surplus lines?
They are, yet there's a number of other players that are involved. So Lloyd's is an easy example that everybody's heard of. I could rattle off a number of other carriers you probably never have heard of, but are A-rated carriers that they've come into prominence because all what we would call the standard carriers, these are the carriers admitted to the state of California that follow the rules and have to follow all the statutes, including the limit of how much premium increase. The surplus lines they're not bound by the same rules. Does that make sense?
Yeah, it does. I appreciate the clarification. Thank you.
You got it. Any other questions before I move on? Okay. Okay, so when is this going to end? I get that question a lot. And what I'll provide is part what we're seeing out there, part of my own opinion, having dealing this on a daily basis. So the legislation, so Ricardo Lara, who is the insurance commissioner for the state of California, again, has been under tremendous pressure for legislative change. There are, if you read insurance headlines as much as I do, you will have seen that Allstate insurance company recently got approved a 20% price increase. And that's quite a bit higher than the Proposition 103, which caps it at 6.9%. So you're starting to see some exceptions being made. Legislation change is being incorporated towards the end of 2024. And the experts out there are saying it could take as much as 3 to 5 years for it really to change the models and to see some real effective change. And the change is focused on the stabilization. So what's happened is because these carriers leaving, the exodus, the sharp increases in premium have happened in a relatively short amount of time. And what's happening is they're trying to stabilize it so it can be more predictable. And one thing that we're seeing a lot of, it's what's called predictive modeling. You may be familiar with what that term is, but in the insurance industry, it's where carriers are using statistical techniques, AI, they're using algorithms to analyze historical data to predict future outcomes. And how this affects carriers is it allows them to assess the risk, again, using algorithms, AI, et cetera, so they can create models that are based on this recent data that allows them to assess risks sooner and quicker. Then it also allows for them to price it accurately. You know, the underwriting piece is it's such a key piece to an insurance carrier's ability to manage their portfolio. And it also allows to detect fraud. Insurance fraud is, you know, it's a big part of how a carrier can remain profitable. And there's other aspects. It can provide greater consumer retention and consumer acquisition. And it also allowing for catastrophic modeling. These are all things that are being introduced today, being introduced at a rapid rate to stabilize the insurance industry. And as I mentioned before, the government intervention and the legislation change, it's just Um, it's what has to happen. And again, it's going to take a while for it to sink in and take effect. But we're all optimistic that change is on its way.
Hey, Bill, a question.
Yes.
For some lines of insurance, certainly life insurance, I know, one of the key sources of income that the underwriters figure in is the investment portfolio return. Is that a factor in property insurance?
It is. So,
And if so, is that offsetting? Given that the stock market's been doing so phenomenally well, has that been offsetting any of the natural disaster losses?
if it has, it hasn't shown up in any of the research or the discussions that we're seeing out there. It's what they're finding is that the modeling was flawed in the 3, 6, 9 year prior terms, because it was they weren't able to take into consideration the increased frequency and severity of natural disasters and the cost of reinsurance. Reinsurance, I would think most people in the room are familiar with that, yet the cost of reinsurance, which is insurance companies buying their insurance, they're spreading out their risk to other companies. The cost of reinsurance has really driven the premium market.
And Bill, I also noticed that it's the I don't want to call it hyperinflation in the housing market, but out here in California, we see it amplified. I'm seeing it in Texas as well. Property value that was fairly stable for nearly 30 years, all of a sudden spiked in Texas with all the growth in Austin, San Antonio, Dallas, Houston. So those properties that were $100,000 are now pushing 300, 400,000. The rates in real estate are going up so fast. If we have a cap on the rate that the premiums can increase, that's going to exacerbate that problem tenfold. Wouldn't you think?
I couldn't agree more. While all of the property owners in this room enjoy an increase in valuation, the sneaky problem with that people don't talk about is the cost of reconstruction and or remodeling. It all translates, for any losses that the increase are in construction costs. So my wife and I, as an example, remodeled our home back in 2007. And now we're starting to deal with things are just breaking right and left. And we're just astounded at the cost of what it costs to replace. And again, just the cost of construction as well.
Yep.
So good point. Anyone else? Okay. So risk mitigation strategies. And these are just practical ideas and recommendations that I share with my clients. These are, again, pervasive, that knowing that it could take up to 3 years for stabilization. And I don't see premiums going the other way, just looking for stabilization. So what are the ideas, recommendations, and strategies that we're recommending to our clients? So when premiums increase and valuations increase, always look at lowering deductibles, or sorry, raising deductibles. At the end of the day, with valuations and inflation, what we share with our clients is looking at taking a higher self-insurance limit. For all of us that are driving autos, we used to, carry $1,000 deductibles. Well, you're not going to turn in a $1,200, $1,800, $2,000 claim anymore. the cost to repair a fender bender has vastly increased. You know, there's sensors on there's cameras, etc. So be willing to self-insure more so as to mitigate the desire to turn in a small claim, and also to manage the increase in premium. Proactive measures. For any of you out there, has anybody experienced your carrier coming back and saying you need to install a seismic water valve release at your home, or a seismic gas valve? These are all items that carriers are requiring homeowners to install, or to have mitigating strategies to reduce claims that would happen on your home. You hear about defensible space. If you have a home that has cypress trees, can't be within 20 feet of the home anymore. There's just a number of ideas that you can work with what you have. And then the last part, for the long-term planning, this is really more focused for the property owners. If there's anyone out there that owns property, rental property, or has clients that have a portfolio of rental properties. I have a client out in East County, San Diego, and this group manages a large number of apartment assets. They own a number, and they manage for even a greater client group. And what we're telling all those clients is, you either invest in upgrades or you invest in insurance premium. And what I mean by that is, for any of these properties that are north of 30 years old, have to have the roof repaired and updated. The electrical panels, they're no longer accepting Zinsco or federated panels. They've proven to have caused a number of fire claims. Plumbing, your plumbing needs to be upgraded. Water losses are pervasive. And then the last part would be your heating, venting, air conditioning, so the HVAC features. If you don't have upgrades, you can expect premiums to jump considerably, or push you out of eligibility for the standard carriers and push you into the surplus lines. So again, it's not an easy conversation when property owners are used to very stable and inexpensive insurance premiums over the years, over the decades even. It's just been a new way of how they have to operate. Otherwise, they're going to be taking that same money and investing in insurance premiums.
Is there also a tendency discreetly for people to just drop the insurance and go uninsured? I suspect that's happening quite a bit out here right now.
Well, I don't see it with folks that own a income producing rental asset. That's just, unless they own it free and clear. Yet typically a lot of my clients that are heavy in real estate, they're leveraged pretty good. And so the banks aren't going to accept a home that's doesn't have the actual property, the structure insured.
Okay. So it's compulsory insurance right now, which is also driving up the cost to some extent.
100%. Well,
Okay.
a lot of them have taken advantage of the low interest rate environment that we experienced, over the last 6-7 years. So they have a note in there that they desperately want to keep intact.
Right.
And so they're
Okay.
not willing to, well, I guess their hand is forced, right? They're really backed into a corner.
Well, and as far as I know, the compulsory aspect, at least for fire insurance, that's a requirement in every state in the country, I think, isn't it? If it's financed, if it's mortgaged,
If it's finance and mortgage, yes.
If it's financed or mortgage, yes, 100%.
yeah.
And I think that's what Bill was leveraging there, that because the interest rates were so low, people were taking equity out of their houses, they were buying new properties, and the amount of mortgage debt skyrocketed, which also drove the prices up. Coincidentally, didn't help any either. But if we had, 8, 9, 10, 15% interest rates, people would pay off those houses as quick as possible. And they might choose not to pay super high premiums on it, just take the risk because they don't have anything, especially lower income families. But you're right. I mean, the compulsory, we can't get a home equity loan or a home equity line of credit without getting insurance on that. So probably for the best.
Yeah, and I don't know if anybody in this room has ever seen what they call forced placement coverage, that banks or loan groups will put on a home or a property. Yet typically a forced placement coverage premium and monthly premium is typically as much as an annual premium with an insurance policy. So you will do everything you can to avoid forced placement coverage. Okay, I thought I would at this point just open it up to Q&A. If there's anyone that there's lots of topics, I can go light, I can go deep, but would just love to hear what you guys are seeing and what's facing your clients.
Bill, this is the other Bill. Just a quick question about rental. I'm a renter, not a homeowner, and what you see in terms of increases for rental or homeowner renters insurance in terms of going forward.
So renters insurance, and I'm glad you brought that up, Bill, because this helps people understand. So think about it this way. There's in a homeowner's insurance policy, there's a property aspect. So it's covering the actual structure. And then on the other side is the liability. So personal liability, somebody getting hurt on that property. So if you're a renter, you're not covering the structure, correct?
Correct.
Unless you're a commercial lease tenant and you're on a triple net lease. So as a renter, you're only covering your personal belongings and your personal liability.
Right.
So those policies are readily available and normally quite inexpensive.
Okay.
That makes sense because you're covering a property value typically somewhere around 100K, and then your personal liability, I would recommend you have at least 300K. Better is 500, and ideal is $1 million. And
right.
Liability coverage is very inexpensive.
Okay, great. Thank you.
Which begs the question now. And I do apologize, Sandra. I see your hand up. Go ahead.
So what are the options when you have a client that needs to get insurance through a loan and they are in a high hazard zone and no one wants to insure them, and you are like stuck in the transaction because nobody wants to insure, the lender wouldn't go without insurance. So it's been tricky lately and the prices are like crazy.
It's been very tricky.
Mm-hmm.
So here's how some of these discussions are not easy. So it's either you and through the tier you would have let's say you get a notice in the mail or an email saying we're going to non-renew coverage.
Mm-hmm.
And it's a state law that they have to provide you 60 days notice. That's 60.
Okay.
So you get the notice. and then you start looking around and notice that nobody wants to insure you. You could be in Ramona or Escondido or in a part of North County, San Diego that's just considered a high hazard fire area. So you go to the surplus lines. Surplus lines, you could find a carrier that will provide coverage, yet it could easily be 2, 3, maybe even 4 times what you normally were paying.
Mhm.
Okay. And then if you can't stomach that, then you would go to the California Fair Plan. And the California Fair Plan, remember, only covers fire. So your lender will be satisfied.
Okay.
And then you have to pair the California Fair Plan with what they call a difference in conditions policy. We call it DIC. And that covers liability, theft, vandalism, water damage, etc.
Okay. Okay. Thank you so much.
Oh, you're welcome.
Bill, if you had to self-insure, what kind of cash reserve would you have to build up to be adequately insured against fire or flooding or something along those lines?
Great question. And shoot, that's if you find yourself in that spot, and if a property is owned free and clear, so you don't have a loan obligation to manage. So in California, in Southern California, it used to be $350 a square foot, yet that's now more like $450, $500. And I would consider that for average to good construction. If things, if you have upgrades, if you have custom floors, special windows, etc., you're going to be pushing up 550, maybe even north of 600 a square foot if you were to do that.
So it would be quite a chunk of money that you'd have to set aside someplace that would at least alleviate some of the costs of a disaster.
Correct.
Yeah.
So I had a question going back to the renter's insurance and the liability for property. Oh, I'm sorry, the liability separated from the property. If we have to have property only without going through the surplus lines, or even if I do have to go surplus lines, it's still fairly expensive. Can I also get an equivalent of renter's insurance to cover that? And if I understood correctly, that's the difference in condition, the DIC, right? So it's cheaper.
So let me see if I understand you correctly, Dennis. The difference in conditions, if you think about, let me start at the whole. So if you have a homeowner's policy, regular homeowner's policy off the shelf comes from Travelers, Liberty Mutual,
Yeah, that covers
Allstate Farm.
Yeah.
So it covers property,
yep,
and
liability.
Liability.
Right.
So in the event that you have to do California Fair Plan, which is property
Worst
only,
case scenario.
and only covering one peril, which is fire, then it needs to be paired with a policy that would cover liability, theft, water damage,
Right.
vandalism, etc. So a DIC. But a renter's policy, the property, it does have a property component to it, but it's only covering your personal property, your personal belongings. It's not covering the floor, the roof. It's not covering the structure. It's just covering your personal belongings.
So once I go to a surplus line, that gets extremely expensive.
Yes,
I want
it
to
does.
put as little as possible in that as possible. Do I have options as a homeowner to get something equivalent to renter's insurance, which gives me the coverage that I need for personal property at a much cheaper rate instead of bundling it in with the most expensive plans?
Okay, I understand.
That may not fall under the DIC. I think it's another gap that may be falling through because, yeah, granted, if I have a water pipe leak, that wouldn't be covered by the fair plan.
That's right.
A water heater, stuff like that. So would it be better to do those as individual policies on a third party, cheaper line that covers my liability aspect of it as opposed to the property structure, which would only be, my most expensive plan?
Yeah, I see where you're going with that. here's how I would answer. So a homeowner's policy that comes from a surplus line has a very similar structure to the homeowner's policy that you would get from, call it State Farm.
Mhm.
And so there is the main structure limit, they call it dwelling coverage A.
Mhm.
The personal property is always a subset of coverage A.
Okay.
And
So
so
it is-
you
it is
get your
coverage A.
personal property covered. So purchasing a renter's insurance would be redundant.
Okay. So it would be covered under the umbrella from the primary property.
Correct.
Okay. Okay. Thank you.
You're welcome.